but family offices can operate very differently. And you have tons and tons of experience, until now, for almost how many, 3 decades or more, right? You've been working with family offices. So I wanted to understand from you, when does a wealthy family, like really, really begin functioning like a family office rather than simply owning a large collection of assets?
Well, look, I think we're at an inflection point, and I think the answer, what is and what should be, are two different answers.
Hmm.
I think what happens today is people have a liquidity event and they sell their operating company and they have a lot of money. And it's in the paper, it's on the internet, people know about it. And what they start doing today typically is they start investing. Their friends hit them up and, they just sold their company for $1 billion. It's in the paper, it's in the press, and they start investing. And the problem with that is that just because you're really good at making widgets or whatever you're good at, doesn't mean you have any clue about investing.
Most investors assume the advantage of billion-dollar family offices, access to more capital, more deals, and exclusive opportunities. But their greatest advantage may be how they think about time, risk, and responsibility. Today, we are going inside how some of the world's most sophisticated families build, protect, and deploy wealth across generations, and which of those principles you can begin applying to your own investment decisions. I'm your host, Vinki Loomba, and today I am joined by Ronald Diamond, founder and chairman of Diamond Wealth, a network of more than 100 family offices managing between 250 million and $30 billion. For more than 2 decades, Ron has invested across private equity, real estate, venture capital, credit, and special situations, giving him a rare view into some of the most sophisticated families, how they think about capital. And he's also a founder, host, and CEO of Family Office World Media, where he brings together leaders shaping the future of private wealth. Ron, I'm super excited that you're here with me today, and I can't wait to explore everything and anything about family offices. So
Well,
welcome to the Wealth Wife Show.
thank you, and it's a pleasure to be here. Thank you. I appreciate it.
So Ron, you have spent more than 2 decades working alongside some of the world's most substantial family offices. So take us back to a particular deal or a conversation when you first realized that family offices were not simply investing more money, they are operating from an entirely different set of priorities or perspective.
Okay, so I'm going to answer that in a couple of ways. From a 30,000 foot lens, let's kind of go out and then we'll zero in. Um, Today, the family office model that exists, there's roughly $10 trillion in capital in family offices and about 124 trillion that's being transferred from the baby boomers to the next gen in the next 20 years. So it is the largest transfer of wealth in history happening now. Having said that, today the model doesn't really work. Only 25% of families make it to the second generation, and 10 make
Mhm.
it to the third, and 5 make it to the fourth. In most family offices, even if they're over $1 billion, most of them are fragmented, inefficient, and siloed. We're trying to change that. So I think that we're at an inflection point, and I think that as private equity and venture capital disrupted the public markets in the late 80s, I believe family offices are not going to replace, but are going to start to disrupt private equity and venture capital because it is objectively a better model if you have the right team in place.
Wow. So, but you've been working with these family offices for a long time. So, but how did you get involved, or how did you come about this concept
Okay,
about family
so
office?
well, it wasn't a grand scheme that I thought out carefully. It was more serendipitous, which I think is true with a lot of people. Um, I graduated from Northwestern University in 1987, and I got a wonderful job at Drexel Burnham. And Drexel at the time was the most profitable firm on Wall Street. That was with Michael Milken, junk bond, et cetera. 2 years later, Drexel went bankrupt. So that's kind of how I started my career. And I got into this industry because I was a bit disillusioned when Drexel went bankrupt. I'm in the room. I was 24 years old. I just lost a good job. But I'm in the room with people in their 60s, mostly men in their 60s and 70s. And they lost many of them lost everything. They had all their money, or many of them had all their money in Drexel stock. And my takeaway from that was, I would always be loyal to people, like ridiculously loyal to people, but I would never be loyal to a company because if this can happen to Drexel, which was Goldman Sachs on steroids, this can happen to anybody. So I moved back to Chicago, started a hedge fund before I really knew what I was doing, raised $2 million from friends and family, and got started right around 1990. And I scaled it. We grew it from 2 million. We had tailwinds behind us because in the 90s, it was a pretty good market for stock pickers and we were pretty good at what we did. And we grew it to about 350 million. I held it for 10 years, sold it in 2000, got my liquidity, and then I started investing. And what we did and what we do is I put together a syndicate of family offices. I started with two. We currently have about 133. And these are families anywhere between 250 million to 30 billion. And we invest together in the private market. So it's private equity, venture capital, real estate, credit, sports teams, things like that. We don't charge anything, but I'm not doing it for self-list purpose. I do it self-ishly because I don't have enough capital to put $100 million in every deal. Now I do. So I call it what I do first call alpha. So that's the main thing that I do. And then secondly, I sit on some advisory boards. So I chair the advisory board for Crescent, which is a $250 billion multifamily office. Chair the advisory board for Opto, which is Joe Lonsdale's company. Joe's the founder of Palantir and Adipar and 8BC and Jake Miller. They created an AI thing for family offices and a few other boards. And then I put together the Family Office Initiative at University of Chicago booth with several other people. So that's basically what I'm focusing on now.
Wow. So let me ask you this question about the MBA program that you started since you were talking about all this, what you're doing with the family offices and how you created the syndication of family offices, which is amazing. And then what is this program or how did that program come about? Because you're not just keeping the knowledge to yourself, you are sharing with others as well through your program.
Yeah, well, remember, the model doesn't work, right? Only 25% make it to the second gen. So we have to figure out a way, and they are family offices. Because you sold your widget company for $1 billion doesn't mean you know anything about investing in private equity or venture capital. So you've got huge amounts of money in very inefficient hands. So the genesis of this was about 5 years ago. This was during COVID. I chaired the Disruptive Technology Center of the advisory board at Stanford University. And I said, let's put together a family office initiative. This is well before what we did at Booth. And we got the green light to do it. And I said, let's also put together a conference. And the investors that invest alongside me, I keynote a lot of these conferences, and they say, "Hey, I see your keynote in this conference. Should I go?" And 99 times out of 100, I'll say no. The problem with not all, but many of the conferences is they're pay to play, and it's become service providers pitching to service providers, and family offices go to one or two and they stop going. So I wanted to put together a family office conference that I would tell my investors, yeah, this is one you should go to. So I went to Kirkland and Ellis. Ryan Harris runs the family office practice for Kirkland. We do a lot of work with Kirkland. And then Bobby Stover ran the family office practice for EY, retired recently. And I said, look, you guys do the heavy lifting. I'll do two things. I will get you world-class speakers and I'll pick the content. You guys do everything else. So I'll give you three quick examples on how this started and then how it evolved and what we're doing at Booth now. So the first guy I called was Paul Carbone, who's a close friend. Paul is brilliant, and he ran the family office for Tony and JB Pritzker. He was talking about diligence. He wasn't pitching a fund. He wasn't raising any money. He was just saying, "Here's how we've done fairly well, and they've actually done extraordinarily well. But we've done fairly well, and here's what we do. We start with 200 companies. It goes to 50. It goes to 20. I kind of come in here. We have an investment committee meeting. We decide if we want majority, minority, board seat, no board seat, et cetera. We vote on it, and we say yes or no." There was no ask at the end. All he was doing is educating us on how they do due diligence at Pritzker, and they've done phenomenally well. Second
Mhm.
example was Tim Callahan. Tim is a close friend now. He was Sam Zell's former partner. He wasn't raising Fund 4 or Fund 5. He wasn't raising anything. is during COVID. He was simply opining on what he thought was going to happen to the office market. Because remember, during COVID, people didn't know if people would ever go back to offices. And
Mhm.
he was just giving his thoughts. And there was no ask at the end. He was just saying, here's how I think it'll play out. And by the way, it played out almost exactly the way he said. But there's no agenda, no ask, just educational. And the last example I'll give you is Denise Illich, who's a close friend. They own Little Caesars and a couple sports teams. She, along with Dan Gilbert, really helped rebuild Detroit. She wasn't asking people at the conference to donate to her to make Detroit better. Um, she was just saying, look, if you're going to be involved in the philanthropy, you need to run it more like a business. And here's kind of what we did right. Here's what we did wrong. And there was no QR code at the end saying, here's how you make Detroit better. She was just educating people on how to make philanthropy more efficient. We had 880 families from 6 continents on a Zoom call during COVID, 420 over $1 billion. It was probably tenfold what Kirkland or UI expected. I had no clue because I wasn't in the conference business, but it was certainly more than I expected. And that sort of checked the box that there's a huge demand for actually pure content. And that's what this is because we didn't have to make money. We didn't have to sell anything. So fast forward 3 years ago, 3.5 years ago, I was having lunch with Michael Milken, who was my first boss from Drexel Burnham, and Steve Kaplan, who was a top professor at Booth, very well known in the private equity space. And I told him what we created at Stanford. I said, let's put together one at Booth. He said, interestingly, Paul Carbone also had approached him and said, I wanted to do some. So about 3.5 years ago, Paul Carbone, myself, Steve Kaplan got together, whiteboarded it, and put together a program at University of Chicago Booth. And what we did and what we do, and it's much more extensive than what I did at Stanford. We've now got a full-time MBA program. So you need to be a full-time MBA student at Booth in order to take the class. We started with a half a credit because we had no clue how it would do. We thought it would do pretty well, but it sold out faster than the private equity class. So it did extremely well. Then we did a full credit, now we did 2 credits. So that did really well. And then we put together an advisory board of some of the largest families in the country. These are family every names that you would know. And then we did a conference. We have a conference once a year. We just had one in May. We opened the Obama Library. We had a dinner, opening dinner there. And then we had a conference. And the beauty of the conference is we don't have to make money. We're not, it's not a for-profit entity. So we could have people, Nobel Prize winners from Booth talking about geopolitics or global economics or tariffs or interest rates or behavioral economics and, and educate without having to sell anything. And so we limited it to, they're all over $1 billion families. We limited it to 175 families. And it was, by far the best conference that I've been to because we're just creating content and we're not trying to sell anything. So that's what and then what's interesting is after we created this at Booth, several other schools from Harvard to MIT reached out. And I think in 3 to 5 years, most of the school business, maybe 7 years, most major business schools will have a family office program. We're the first to really do it at Booth, but I think
Wow.
in 5 to 7 years, it'll be commonplace because there's huge demand for it.
I used to teach the executive MBA program. So those are all the line one managers, but that terminology was not even there, the investing or the family offices.
Right. So, and we are starting an executive education program. Bobby Stover and Stephen Roach and a few other people are spearheading that. And we're starting that in November. So we will have executive education with taught by some of the top practitioners in the country. But the results of the family office class it's taught by Professor Heaton. He's a full-time professor and he does a phenomenal job. We have different. I guest lecture some of the classes. Paul Carbone we have different guest lecturers, and I think the students get a ton out of it. I mean, and my thought
Okay.
process to put this together was, today the top kids out of Booth or Kellogg or Wharton or you name the school, they want to get into private equity, venture, real estate, hedge fund, etc. Nobody necessarily wants to get into family offices. With 124 trillion being transferred from the baby boomers to the next gen in the next 20 years, which is transformative. I think that working for a family office in 3, 5, 7 years directionally will be the first choice of these kids, and you have to educate them at the MBA program. So that's what we're trying to do.
Great. So who's this MBA program is for? Who are the I would say, a perfect candidate for your program.
Well, the MBA, you have to be a full-time MBA student at University of Chicago Booth. So it's only people who are currently at University of Chicago Booth, full-time MBA program. That's the only people who can get in. And the class sold out instantly.
So is it like the undergrads can join too? Is it like more
No,
like a executive level program?
no, you have to be a full-time MBA student at Booth, enrolled at Booth, full-time to take the class. We have an executive education, which is a different program, but for this program, you need to be a full-time MBA student at Booth, no undergraduates, full-time MBA.
So it's just like a full-time student, and this course is offered, and they can enroll in that and get that program. Wow. So let's talk about the family office. The term family office is often used as though it describes one standard structure. At least in my mind, I think that. But family offices can operate very differently, and you have tons and tons of experience, until now, for almost how many, 3 decades or more, right? You've been working with family offices. So I wanted to understand from you, when does a wealthy family like really, really begin functioning like a family office rather than simply owning a large collection of assets?
Well, look, I think we're at an inflection point, and I think the answer, what is and what should be, are two different answers.
Hmm.
I think what happens today is people have a liquidity event and they sell their operating company and they have a lot of money. And it's in the paper, it's on the internet, people know about it. And what they start doing today typically is they start investing. If their friends hit them up and, they just sold their company for $1 billion, it's in the paper, it's in the press, and they start investing. And the problem with that is that just because you're really good at making widgets or whatever you're good at, doesn't mean you have any clue about investing. So you've got
Hmm.
huge amounts of money in very inefficient hands, run very poorly without the proper structure. So
Hmm.
what happens today is people have a liquidity event, it's in the paper, they start investing. That's the last thing you should do. The first thing you should do is something called governance. Most people who have a liquidity event in again a widget company have no clue what governance is. Then you need to do succession, next gen, family dynamics. You need to have your estate planning attorney is probably more important than any investment manager you're going to hire because that's the structure of it. And then maybe after 12 to 18 months, then you should start investing. But there's no playbook for that. And that's the
That's
way it should be, but that's not the way it is.
Interesting. So, but that separates the, like, I would say, wealthy people than the people who have set up the family offices, right? So, what is the right point when people think, okay, I exit this maybe 100 million or 200 million, this thing, and I wanted to invest. But at what point somebody should be thinking, okay, I do need a family office services, I do need a structure.
Well, first of all, I've written and spoken about this extensively. I believe, and again, I don't judge anybody. I believe 75, 80% of the family offices that exist shouldn't exist. They should morph into the multifamily offices. That's what the Cressets of the world were created
Hmm.
for. Um, and I think there's going to be a backlash. I think a lot of these family offices will morph into the multifamily offices. There's no playbook. In order, like, how much money do you need? If you sell your widget company for $100 million, that's a ton of money. It's not even close to have enough money to have a family office. So the
Hmm.
question then is, how much money do you need to have a family office if you're going to invest in the private markets? And the
Hmm.
answer is probably anywhere between 500 million and to $1 billion if you're
Oh,
going to have a
okay.
full-time deal team. And there's a ton of family offices that have a lot less than that, and they have a family office, but they'd be much better suited at a Crescent of the world or a multifamily office because rather than paying for their own accountant, their own admin, their own lawyers, their own everything, they split the cost with other families. That's why multifamily offices were created. The multifamily offices is really where the growth is going to be. And those are typically if between 20 million up to 500 million, you're better off in a multifamily office. If you have over 500 million, you still may be better off in a multifamily office, but you have the optionality of you have enough funds to do it in single family office.
So what is a multi-family office? So I'm assuming lot of family office kind of do group together and they're sharing the services. But I wanted to hear from you.
Yeah, so basically, I chaired the advisory board for Crescent, which is 200 it's 250 billion assets under management and advisement, and I think they're best in class, but I'm a bit biased. And basically, what they do is they do everything. They do, it's not just investments. There's bill pay, there's lifestyle, there's succession, there's next gen, there's philanthropy, there's all these different things. So what the multifamily office does is they pool several families together. So rather than paying for the accountant yourself, And rather than paying for the deal team yourself, you're splitting it with a number of families. That's what a multifamily office is.
And you have one of those set up
Well,
yourself,
I don't
right?
have, I chair the advisory board for Crescent, which is, my opinion, the top multifamily office in the country right now. But there's a lot of different multifamily offices that exist right now. And I think the growth is going to be in the multifamily offices, not necessarily in the single family offices.
There's a lot of people, they are running this family offices, multifamily offices. So they're bringing together so many different families and they're teaching them how to start a family office, right? And that's the number one. And a lot of times I have seen that the families do not even have 100 million to start a family office. They're like sitting below 50 million and they're calling themselves family offices as well. So, first question is, as an investor, how do I evaluate that this is the right family office or no? That's the number one question. And if somebody is looking to join a multifamily office, if they are truly family office, if they do have a net worth of more than 100 million or close to 100 million, how would they know which is going to be the right place to go where they're getting the right resources to expand? So it's like twofold question. I'm asking the investor side as well as the family office side.
Yeah, so I think it's a great question. I think that it's really, there's a lot of multifamily offices that exist right now.
Mhm.
I cheer Crescents and I think they're best in class at what they do. But there's other ones that are very good too. And so I think the industry has really grown. The reason for the growth really is that the big wirehouses, and I won't name the firms, but most of the major firms that you know of, they're not even fiduciaries, and that's head scratching. I mean, so RIAs really took off. I mean, in the last 20 years, and a lot of people left the big wirehouses who were making money primarily by selling their own product, and the RIA was a better model. And they're fiduciaries, right? So they have to do what's best in the best interest of the client, which seems kind of commonsensical, but they're fiduciaries. The multifamily offices have come in probably the last 5 years, have really grown. And that's basically an RIA, but they don't just look at creating alpha, making money in stocks and bonds. Now they look at the whole picture. They look at the person holistically. So they look at estate planning, wealth transfer, governance, things like that. Setting up children in business and figuring out succession plans and things like that. So the multifamily office has evolved. It started with the wirehouses.
Mhm.
That changed to RIAs, and the large RIAs morphed into the multifamily offices. And I think that's really where the growth is.
Oh, great. Good to know that. So let's look into it, how a family office evaluates a deal. So I wanted to really understand the investment process for a family office. So when an opportunity reaches a family office, what must be understood before projected returns are even considered?
So this is a relationship business.
Hmm.
The first, second, third thing a family office wants to know is, can I trust you? Who are you as a person? The fourth thing, then they'll diligence your track record. Now that's flipped institutionally. You go to an institution, the first thing they want to know is what's your 1, 3, 5 year track record, what's your biggest drawdown, what are the statistics, then they'll diligence you as a person. So the thing to understand is this is a relationship business,
Hmm.
and it's not one that's just based on numbers, because family offices, a lot of the reason family offices exist is because there's a lack of trust for Wall Street. So the answer to the question is, there has to be an inherent level of trust and understanding with the person before you even understand. Because if you can't get past that point, I don't care how good your track record is, you're not gonna be able to work with family office.
So relationship, that's a good thing that you mentioned. So how do you build a relationship with the family offices? What is the first step? Is something somebody's new in the
Well,
game?
look, it's your life, right? I mean, people have let me. If you're a good person in general, and people know if you do good deeds and you're good, generally good, you have a reputation. And if you're not, you also in the community have that reputation. So, if you want to start working with family office, I think, you know, the most important thing is you have to be a good, honest person, and with a really good reputation. That's the most important thing. if you don't have that, you'll never be able to be successful in the family office space. I don't care how smart you could be, the smartest person in the world. You're not going to be working with family offices because this is a business based on trust, not necessarily just economics.
If somebody is new, how they can break in, or how can they, set up that credibility with the family office, or even just to get started, like somebody is even get to speak to them to build that relationship or the credibility that could take them to the next level.
It's based on your reputation and can be based on references. So people that you know in common that can give you references and talk about, and the interesting thing is if something goes well, it's great to give everybody a high five and say, yeah, this investment did great. What families really want to know is a lot of investments don't work out. I mean, I have had many that have worked out, and I've had many that haven't worked out. Hopefully, you have more that work out. But what the family wants to know is how does the general partner react when things go poorly? Do they stop communicating?
Mhm.
That's the opposite. If they do, that's a horrible thing. They should communicate even more. Are they looking for excuses? Do they explain, etc.? And I think that that's really what separates the people who are going to be able to work with a family office. Because again, it's not when things are going well where the person, the general partner who can work with family offices, um, make their reputation. It's when it doesn't go well, how do they behave? And you want to know how do they behave? That's the most important thing when something does not go well.
Yeah, I think you're right about that. How much interaction you have personally with the operator or the syndicator? Not much, right? Because you have the advisor sitting there on the board and doing everything for you, or the due diligence.
Well, mine's not so much a business. Basically I put together a syndicate. We've got about 133 families where we just invest together. So it's not really a business per se. It's a way for me to take a finite amount of capital and
Mhm.
aggregate with other people, so I get better deal flow and better execution, and I get access to, better economics as well. So that's kind of how and why we structure it that way.
So, if a family can preserve its financial assets and still fail to preserve its unity, values, ability to make decisions together, where do you see the greatest breakdown between the generation that created the wealth and the generations expected to inherit responsibility for it?
A lot of it's entitlement. A lot of it's ego. Because mom or dad or grandma or grandpa did really well, and you're fortunate to, have inherited a lot, doesn't mean you've done anything other than, you're part of the lucky sperm club. I mean, so, and yet sometimes people look at things differently. So I think part of the problem is ego. And that's a huge part of the problem. How do you raise kids with gratitude and not entitlement? I mean, if you're flying private wherever you go, and you know that's wonderful, but you have to instill a work ethic, because the chances of the second gen doing as well financially as the first gen is probably not great. And that creates a whole bunch of psychological issues, sort of like, how do I do as well as mom or dad? I'll never sell my company for $1 billion, or my dad just sold his company for $2 billion. I don't have to work anymore. Well, that doesn't work. And you have to raise them. You give them a ton of access to things, which is wonderful, and you want to give your kids as much as possible, but you have to keep them grounded. And so you have to focus on gratitude rather than entitlement. And I think that's something a lot of families, it's hard. There's no playbook for
I
that.
agree.
It's hard.
I agree on that. So, what do you think? When should the next generation begin participating in the financial decisions?
That's there's no right answer
As
for that,
early as
because
possible.
there's some second generation that they shouldn't even be in the business, and there's some that were wired to be in the business when they were 18 years old. So it's dependent upon how they're wired, what their motivations are, what their goals and objectives are, and what their values are, if they're aligned. And if they are, that's great. And if they're not, they shouldn't be part of the family office. And so then you would look to hire people outside of the family. So there's a whole bunch of different issues we've got. But again, I used to think we're in the second or third inning. Sometimes now I think we're in the first inning. We're at an inflection point. So 10 trillion in capital, 124 trillion being transferred from baby boomers to next gen in the next 20 years, largest transfer of wealth in history. And I think it'll fundamentally change the way companies are financed and the way philanthropies are funded going forward. So it's massive. This is private equity and venture capital in 1987. That's what family offices are today.
Hmm. I wanted to ask you one technology question too. So now the AI is like everybody's using AI. Where will AI create the greatest advantage for family offices over the next several years?
Okay, so AIs will fundamentally change. It's going to fundamentally change everything. I mean, the internet changed everything too,
Hmm.
but this is different. This is computers getting smarter. So I read and I get a little bit smarter. Computer reads, it gets a lot smarter real quickly because it can aggregate everything. So I chair the advisory board of a company called Opto Investments. And
Okay.
what they did is it was created by Joe Lonsdale and Jake Miller. So Jake came out of Bridgewater, and Joe Lonsdale, a lot of people know, he's the founder of Adipar, one of the founders of Palantir, 8VC, just extraordinarily successful investor. And what they did is for family offices, they created a system. They basically took about 20 engineers from Palantir, 20 engineers from Adipar, and put them together in stealth mode for 4 and 5 years, and came out with a product where smaller family offices now can now invest alongside the larger family offices. So 95% of the time of what I do during the day and what a lot of the family offices do is basically look at deals. And of those deals, 95% of them you're not going to do. You're going to cherry pick two or three that you're going to end up doing. What Joe and Jake and Ryan have created is a system where you could now say, I only invest in lower middle market manufacturing companies in the Midwest between 2 to 5 million EBITDA that are countercyclical, and I don't like alcohol and tobacco. Or you make up whatever parameters you have. Now, 100% of what comes in fits your criteria. So then it's a question of diligence. So it's gonna almost democratize a lot of the family offices who don't have a team like the Pritzkers or the Crowns or the Dells or the Bloombergs of 70, 80 people. You could now have a team of 3 or 4 people and compete directly. So I think that's going to fundamentally change things. And the response to Opto has been extraordinary. But I think, again, there will be other companies also that exist with AI, and AI is going to change things where we can now do things in 30 seconds, what it would take a 5 year analyst 2 weeks previously to do. Now, that's a great thing for the business. It's a philosophical problem for the younger generation because what happens to the younger generation if you don't need the analysts, et cetera. So there's pros and cons with it. From a business, from a maximizing profit standpoint, it's certainly better. But from a philosophical standpoint, we need to get our arms around. My daughter just graduated from Tulane, and they mentioned the word AI at graduation, and the kids started booing. Um, it's happening. And a lot of kids are really freaked out about AI, but you really have two options. AI is happening, period, full
Period.
stop.
Yeah.
You could either ignore it and put your head in the sand or embrace it. If you ignore it, you'll be left behind. If you embrace it, you won't. And so what these kids have to understand is it's like when the internet came out, you have to understand it and embrace it. It's nothing to be scared of, even though people think that this computer is going to take my job. You still need human beings in everything you do. And people thought when the internet came out, well, if you have computers, people won't work. Well, when the internet came out, it actually increased the number of white collar jobs. I think it's going to happen here. It's going to change. You're not going to need the analysts. You're not going to need certain things. You're going to always need people with relationships. You're going to always need a human in a loop to look at EQ, not just necessarily IQ, and also to be able to judge fundamentally the different people and use their perspective and their intuition. So I think that it will fundamentally change the way the world is. I think the positive is in the healthcare space, we'll get quicker cures to things like Parkinson's and dementia and Alzheimer's and things like that, which is great. I think in the negative space, there's always bad actors and there's always people who are going to do bad things. And it's a fight, good guys versus bad guys, and hopefully good guys win. I'd like to say everybody's good, but they're not. And so I think there will be a lot of really good developments that happen through AI, but also a lot of negative things that come out of AI. And we're already starting to see it.
That's true. Yeah, there's always risk, whenever something new comes out because there's a lot of unknown. And I think that's what people are scared of. Not that they're not scared of AI, they're like kind of scared of unknown, the risks involved with
But
that.
this is different. This is computers getting smarter. This is like
Exactly.
I could read 5 textbooks and learn a little bit more. So now I'm more knowledgeable about whatever subject I studied. A computer could just take everything that's all the data that's out there and just absorb it instantly. So we've never experienced anything like this before. When ChatGPT came out, I don't know, 3.5, 4 years ago, it was sort of like it, it was a game changer. But people didn't fully embrace it. And now the corporations now, the institutions are realizing that AI, if they don't get learn about AI, they will be left behind and there won't be a business down the road. So I think it's going to fundamentally change things, but I look at it more from an exciting standpoint and the good thing that's going to do with healthcare and things like in education and democratizing things rather than some of the negative things that we see happening.
But I agree on that. AI is here to stay. It's not going to go anywhere. It's going to change the world very different way. So I'm going to ask you one capital question now. So there comes a point when additional wealth may no longer meaningfully change a person's life or a lifestyle. At that stage, what should capital be asked to accomplish?
Um, Freedom, choices, optionality.
So let me ask you this. How do families define what their wealth is ultimately for? What do you hear from the different families when you
Again,
work with them?
it's a great question. No specific answer. It's all over the place. I mean, look, to create wealth, to and hoard it. What good is that? It's not good for you. It's not good for the kids. It's not good for society. Um, why do you want to make your great grandkids, wealthy, um, and just give them stuff without giving them a work ethic or things like that? So it's defined differently by everybody, but I think what it does is it gives you optionality and it gives you the freedom to do more things, and that's how I look at it.
Yeah, I agree with you. I think of it as an energy, and it should be flowing in the right direction to keep everything in kind of in place. So I'm going to ask you one golden question, Ron, at this time. You have spent decades observing how substantial wealth is created, invested, protected, and transferred. If every investor listening could adopt one discipline from the most effective family offices which discipline would most change the trajectory of their wealth over the next 20 years?
Listen, you got 2 ears and one mouth. Listen more than you talk. And most of us aren't so good at it. I'm a good listener. I'm working at it to get better. But listen to people who've done it before, who've gone through it, and have succeeded, and listen to the people who didn't succeed, and see what they got right and what they got wrong. It's not a direct correlation between intelligence and success. It's a question of there's so many different variables involved in it, and you just have to look at. My advice would be if you have a liquidity event and you have enough money to start a family office, talk to as many family offices as you know, find out what they got right, find out what they got wrong, listen, and that's by far the best advice I can give anybody.
Listen, I love that. But why do very few people practice that consistently?
Because ego is a double-edged sword. I mean, you need an ego to do well, but ego, I think, is the biggest problem a lot of people have. I'm good at a couple things, and I'm horrible at a lot of stuff. Because I'm really good at something, and I sold my widget company for $1 billion, doesn't make me great at everything. And I think what happens is it 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 it's an ongoing cycle. So you sell your company, everybody thinks you now know how to do A, B, C, and D. You really just know how to build a widget company, which is great. So I think that ego is probably it's a double-edged sword, and
Yes.
it's probably the biggest obstacle for many of these families to truly succeed.
I agree with you 100%. Oh my God. This is a wealth of knowledge, Ron, because like you said it very well, not everybody knows everything, and there's no possible way that every or anybody can know everything because somebody's good at something always. So this brings us to a rapid fire round. I'm going to ask you 5 questions. You're going to answer it in one word or one sentence. Are you ready?
I'm ready.
Great. So, what is one habit you would never give up?
Focusing on gratitude.
What is one book that changed how you think?
The go-giver.
What is one word your closest friends would use to describe you?
Love.
What is one place you return to when you need perspective?
The dog park.
What is your wealth vibe?
Freedom.
Great. I love all those. So, Ron, at this point, I'm going to ask you, you have shared wealth of knowledge with us and your MBA program. If somebody wants to know more about you or about your program, how can they connect with you?
Well, I've got a chief of staff, Cody Meltzer, who's put together a terrific platform, Family Office World Media. So it's familyofficeworldmedia.com. It's a way to kind of educate and bring the communities together. And also, I'm fairly prolific on LinkedIn with posts, again, that are more informative than anything else. So probably that, either familyofficeworldmedia.com or through LinkedIn.
Thank you, Ron. Thank you for taking us beyond the image of family office wealth and helping us understand the discipline, the relationships, and the governance. I think you talk about long-term thinking as well. That's required to manage capital across the generations. Thanks again. And everybody who's listening, I'm pretty sure you have enjoyed this episode. So stay inspired, stay intentional, and keep building your wealth tribe. We'll see you next time. Thank you so much, Ron.
Thank you for having me.
Thanks for tuning in to the Wealth Vibe Show. If you enjoyed the episode, be sure to subscribe and leave us a 5-star review. And don't forget your free gift. Download the Busy Professional's Guide to Real Estate Investing at loombainvest.com. See you next time with another amazing guest and another powerful conversation.